Okay, I think we have some attendees now, and let's dive straight in. Hello and good morning again. Finally, we are here in December. I'm waiting for the peace and quiet of the last few weeks that can really get us, ready for the volatilities of 2023. But so far, that has been elusive, really. We had another roller coaster week last week. Let's get into it. Let's understand what happened and what to expect this week as well at Saxo's weekly market outlook call. I'm Charu Chanana, market strategist with Saxo Singapore, and I'm joined today by my colleagues from Sydney, Jessica Amir, and from Hong Kong, Redmond Wong. So we had quite a sharp run in the markets after Powell's speech last week, which was on Wednesday. And as you would recall, we spoke about that on our last Monday call as well. So the market was really positioned for a hawkish surprise because that's what we're really, kind of now used to getting from Powell, at least since the Jackson Hole. And then at the November FOMC press conference as well, he kind of shot down the markets in a very direct way. But this time he sounded a lot more lame, I would say, if I can use that word. He didn't add anything new, and just highlighting that Fed will move to a smaller pace of rate hikes soon, which is as expected, 50 basis points most likely in December. And he also said that terminal rates need to be somewhat higher. So again, something that he has already said before, that the dot plot will likely move a little bit higher from what was seen at the September meeting. But that brought about a huge market reaction because the way market was positioned for Powell really. But then at the end of the week, the last 2 days actually saw some quite interesting data. We had the weaker than expected ISM manufacturing, where we saw a contraction for the first time since the pandemic outbreak months. But the reaction from the equity markets, as in the past, generally weaker economic data has been getting positive equity reaction in the hope that the Fed will slow down. But that seems to be in a flux now. It's changing slowly. We didn't get a positive reaction from the equity markets on that weaker than expected ISM manufacturing. And what that means is really that bad news is now hitting the markets with recession concerns, and the jubilant reaction that we would get earlier on soft data boosting Fed pause hopes is now diminishing. Finally, we had the jobs report on Friday, which showed that US labor market is still quite hot, steady unemployment numbers, strong wage growth still. So again, hard to say that inflation is coming down that easily. And not to forget, China is reopening, which could mean another leg higher in commodity prices as well. And financial conditions have really eased considerably in the last few weeks as well. So inflation concerns also here to stay still as we get into 2023. Well, that was the macro recap for the week broadly. We will get to what to expect this week later on this webinar, but let me pause here first and let's jump over to what's more interesting for the markets right now and what's happening in China with Redmond.
Hi, morning everyone. Is that the focus is really on the China reopening, and I think starting from Guangzhou, and then later on the comment from the Vice Premier Sun Chuinan, and she's actually has been in charge of fighting, implementing the COVID restriction, and she acknowledged that the Omicron variant being less deadly. And then later, actually over the weekend also, there's another Chinese health expert also giving much softer tone on that. And so we have been seeing a lot of the cities one after one relaxing PCR test requirement, and that has been encouraging, and the market has been rallying on that. I think that will continue to be the focus. And this week, another thing I think I need to bring out is China will have an important meeting at the Politburo. The Chinese Communist Party's Politburo will meet early December, probably this week, and because they need to, that will be the first time for the new Politburo to sit down to discuss about economic policies, and because it's in the mid or later second half of December, and China is going to, holding a central committee work conference on focusing on macroeconomics policy. So the Politburo will meet first and to set the tune and for it. So that if any read out or any news coming out from that, and will give us further uh, ideas is what kind of any policy changes or the policy directions and in China on the economic front. So that will probably will be more important, more interesting than the number, economic number coming up. And today we have Caixin PMI services, but because it comes from mainly November, so early part of November, so when the country, many cities were still under lockdown, so it's expected to be weak at 48 and lower than last time. But those probably will not be the market focus. And also the CPI and PPI are expecting to be a decline 1.5% and CPI up 1.6%. That will be later this week, and those probably will be the market mover. And the credit data might come also later this week. The aggregate financing on the new loan data, and the government has been pushing the bank to extend more credit, and also including to the property sector. That has been also good news, positive news. But the number probably will not be so on those November credit number yet, because it's because you have been the credit demand during the lockdown and the restriction demand for loan will probably still be subdued. So but I think now the market will be looking more forward. And also over the weekend, there's also news. Actually, late Friday after Hong Kong market close, we also have the news coming up, come out saying that the government have asked those large policy bank, large state-owned bank to lend. Provide offshore financing to property companies so that they can meet the wall of refinancing need and to repay the overall they have borrowed a lot overseas, and so and basically they were shut off from the market, and they can't issue any bond, and so the government has instructed those banks to provide offshore financing to help some of them to repay their debt overseas. So that is also a positive side to. So basically, the week started at a positive tone in China. And I think that's all I want to say about the Chinese market. I pass it back to you, Charu.
So yes, China reopening certainly looks like it's the bigger theme, at least for this week in the markets, with the Fed also going into a quiet period ahead of its next meeting. Also, I mean, if you want to, take a look at our platform, Redmond has actually written a brilliant piece about the potential recovery in China's A-share market, because the credit impulse in China is actually trending quite high now. So what that means for China next year, if you want to position yourself, what is the best theme to explore? I think there are some brilliant ideas for inspiration in that piece. But let's now dig deeper into equities with Jessica, perhaps, and what she's watching with this Fed in a confusion and China's optimism as well.
Yeah, I think there's a lot to be said about reflecting on performance, because sometimes the market is telling us who could likely be the best performers going ahead. We know why that is. It's because the market is forward looking. So on the back of Shanghai and Hangzhou scrapping PCR testing, before people can enter public venues, and that, of course, they're two very important cities, as we've been saying, and that follows some restrictions easing in pardon me, in Shenzhen and I don't know how to pronounce the name, pardon me, Guangzhou and Beijing. We are seeing, I guess, optimism that consumption could pick up. So I'd like to draw your attention to Saxo's equity baskets. So if you actually have a look, we track global stocks all over different indices in different jurisdictions, and we group them into key components that we think are really potentially worthwhile watching. And if you have a look, this over the last recent period, not only over the last day, week on week and month on month, Saxo's China consumer and technology basket has been performing the best. And I think the thinking is that given that people will likely be more inclined to be out and about, we could see consumption literally increase. So if you have a look, if you go onto Saxo's platform, click under inspiration, then click on stocks. So 3 simple steps. Inspiration, stocks, and then you'll see the basket called China consumer and technology. And in that, there's some stocks that you might like to look at that have got high exposure, making the majority of their revenue from China. And you'll see that JD.com, it's up about 50% month on month. But you also do have other Chinese giants like Neo and Alibaba. They're up about 40%. Really worthwhile reflecting on Alibaba. For those that don't know, Alibaba, their home, I guess, their mothership is based in Hangzhou, and they're one of the key cities that ease restrictions, with those restrictions being announced earlier today. So I think that is going to be something to watch, but also Tencent and those other tech and consumer focused stocks. So tech, consumer facing stocks in China are ones to watch. Also, just rounding it out, what else to watch? Well, commodities. Commodities are being bid today in the Asia Pacific, and the all important iron ore price, iron ore being one of China's largest imports, the iron ore price is back above $100 for the first time since August. So the iron ore price, for those that don't know, is pegged heavily to Australia's surplus income. And the reason that is because you've got the world's largest, or some of the world's largest iron ore companies in Australia. And so the iron ore price, if you think about where it's gone from the low to now, it's up about 38%. So quite considerable. Again, thinking about this, the market is forward looking. There's hope that China could increase commodity demand. And this is also supporting the share price in some of those key commodity companies. So BHP, which makes the majority of their revenue from China, along with Rio Tinto, Fortescue Metals has the most exposure to China. They're all doing quite well. So too is a smaller company, Champion Iron. So there's some things to watch, but I'll leave it there.
Thank you, Jessica. Let's pivot back now to the US macro and discuss what is really key to watch this week. As I said, the Fed really goes into a quiet period now, ahead of that December 14-15 meeting. So focus really will turn towards incoming data for further direction in the yields and the dollar. We are testing some very key levels. US 10-year yields are at the support level 350 there. Friday's close, despite that turn higher, after the NFP. I think the also important thing to watch really would be any comments or tweets from the Wall Street Journal, whisperer, as he's usually called, Nick Timiraos. So he usually comes in just ahead of those Fed meetings, and when the other members are not really allowed to speak hints from there. But I think, again, like I had mentioned earlier, for the December meeting particularly, 50 basis points seems to be kind of sealed for now, unless of course we see a big move in the CPI, which is unlikely. We know CPI is trending a little bit lower at this moment. And I think in terms of data, we have ISM services today. And again, the impact that we saw from ISM manufacturing last week, with concerns now pivoting towards recession. So that will be again key to watch with ISM services, although that still remains quite a bit in expansion as against the contraction levels that we are now seeing in the manufacturing side. And the other key data to note this week would be PPI on Friday, and that will likely continue to show a modest deceleration as well. So not a lot really. I think it'll be more about how positioning for that December Fed meeting moves. Like I said, important to watch that 350 level in US 10-year. Also in FX, I think we are at some key levels, in some of the important currencies. Yen, most importantly, it is testing the 200-day moving average at 134.50 and we will continue to watch for some more comments this week from BOJ officials. Some of them, we've highlighted this earlier as well. Some of the BOJ officials have been hinting that a policy review could be conducted soon, potentially also before Kurora retires in the spring. So that is obviously lending some support to the yen along with the weaker dollar as well. So keep that on your radars. Euro has broken above 1.05. So getting back to those June levels now and looking extremely stretched here. Euro longs have been a little bit stretched now at these levels. Euro yen could be interesting as it's heading towards 140, and then that is just below that we have the 200-day moving average as well at 139.13 there. Aussie still supported around 68. Jessica, do you want to take that up? And what are we watching? We important events or data this week from Australia?
Yeah, sure. Yep. So obviously the Reserve Bank of Australia meets this week. So Tuesday, we are expecting the third consecutive 0.25% hike. What is really interesting is, usually a currency rallies when a central bank is hiking their interest rates. But of course, in Australia, down under, we've got a huge risk. Last week, we saw lending data and property commitments continuing to slump off their highs. And so this is a concern because obviously, again, remember, we talk about market being forward looking. So the market is really forward looking, expecting more delinquencies to come through. So we do think more pain is ahead in the financial sector. But bring it back home to answer your question. Reserve Bank of Australia is expected to hike by 0.25%. When you've got the Fed hiking by potentially 0.5%, obviously that would support upside in the AUD against the USD. So that's something to consider. But when you are thinking about the Aussie dollar, we're chatting a lot to clients about the AUD's upside. And we've got to remember the commodity currency, the Aussie dollar, often typically does well when China is buying commodities like hotcakes. And now the forward thinking is that with several key cities in China slightly easing restrictions, commodity demand will pick up. And that's why the AUD against the USD, the Aussie dollar against the key currency, is up 10% from its low. So I guess the next key focus area would be the 70-cent mark for the Aussie dollar against the USD. However, we do have to get a lot of kicks for that to happen, keeping downside in mind. We do think the Aussie dollar against the USD could possibly take a haircut, given the Fed is probably going to hike by 0.5% next week. That's more than the RBA can. But in order for a short-term upside to continue in the Aussie, we need to see more restrictions being eased in China. Also, keep in mind a GDP data out on Wednesday. We're expecting the Aussie economy to show that growth is continuing. And also the next day we get trade data. This will be really important to the Aussie dollar against the US because we're expected to see a softer surplus because demand for Aussie commodities is lower in October. We know that demand for Aussie commodities typically peaks up later in the year, coinciding with Northern Hemisphere winter, when people want more coal and LNG. So that's something to keep in mind. Thank you.
Absolutely. So also just to add, we had the softer CPI in Australia, and I think the key risk to monitor out of this RBA meeting this week will be if they hint at further slowing down the pace of rate hikes, so maybe in increments of less than 25 basis points again going into 2023. And then there's a gap. RBA does not meet in January, so the next meeting will only be in February. So I think it's probably a bit too early to signal that, but of course watch for that because that can be a mover for the Aussie dollar as well. But having touched upon some of the key levels that will be worth watching this week in FX, and most importantly, like I said, the US 10-year, I think let's also bring in Redmond who can touch more upon treasuries and bonds and what's happening there.
Yes, thank you, Charu. Yeah, and as Charu said, the 350 is a very important level for technically for the 10-year to watch. It actually, it briefly, Friday it closed below, slightly below 350, and it went as low as 347 and closed at 449, 349. But now in Asian hour, in Tokyo cash market trading, now back up to 352. So it's important to see whether tonight in New York, whether it will break that 350 level again, or actually is bounce back from there and going higher. And just another thing interesting to mention is the curve inverted quite a lot on Friday. What I mean is a 2-year yield actually up 4 basis points. At the time closing at 427, but from 5-year all the way to 30-year yield actually came down. And why is it so? And yeah, I mean, it's that the average hourly earnings number on Friday was actually quite alarmingly high. And so initially, all you jump. I mean, 2-year yield once jumped 18 basis point to 441, and the 10-year yield once jumped 13 basis point to the loft and to 363. So, and because it's that 5.1% year-on-year rise in November, and also the revision in October to 4.9 in I from 4.7. If you look at the more near term, the 3-month annualized rate of changes, is actually you have a 6 handle. In the wage inflation pressure. So that is make the Fed's job more difficult. And yes, I mean, it's as Charles mentioned, the Wall Street Journal journalist who usually is a quite kind of mouthpiece of the Fed, and still indicating a 50 basis point. That we still move down to from 75 basis point to 50 basis point in December, and we also expecting that will be 50 basis point, and the market is also pretty much pricing that. I think the interesting thing more on Friday will be how they price the February meeting rate hike, and before the meeting, I think there's more expectation for that. May probably will be drift down to 25 basis point in February, but after the number on the average hourly earnings, and now market has assigned less than 20% probability for a 25 basis point hike in February. I.e. is more so maybe still 50 in February. So, but of course that is remain to be seen. And so interesting is that the longer end is has been quite well bid over the full the whole November. If you look at the stock market, S&P up about 8%, and Nasdaq up about 10% in November. But if you look at the long end, like for example the ETF TLT up about 11%. And actually, the best performer in that space actually is the tips. 30-year tips actually jumped more than 16% in price. Why is it so? Because real interest rate actually came down. And people looking for duration, and so we probably will talk a little more about on that and explain, give some ideas is why the tips. Those treasury inflation protected treasury now start looking quite interesting. Actually, they were a best performer in November, and I think I stop here and I'll pass it back to you, Charles.
Thank you, Redmond. Yeah, good point there. We did a webinar last week. If you want to know more about bonds, where to position yourself, I think Redmond did discuss a few good points there as well. And like he said, of course, watch for more pieces from him, which you can find on the platform, probably one on tips very soon as well. But before we close, just touching very briefly on commodities, industrial metals have had the best month in November. As Jessica also mentioned, iron ore, all of those actually supported by China optimism as well as lower yields and dollar. Some very key levels to watch this week in gold and silver. Gold particularly, testing 1800 now, but 1808 will be the key level to watch there. And for silver, it will be 2335. So keep those on watch as well. And oil also bumped higher last week, but of course, volatility will remain because both in demand and supply side are in a flux there. OPEC did not really cut production over the weekend as was expected earlier last week. Now focus is really back on the Russian oil price cap, which kicks in from today as well. So the EU has decided that the cap will be at $60. But let's see if there is any retaliation on that from Russia. Watch for comments from Russia on whether they will continue to supply oil or not, and that can potentially create a lot more volatility in the energy markets this week. But I think that will be it from me as well, unless anybody has anything to add on. Jessica, Redmond?
We've covered it
No,
all.
fine.
Plenty to watch. Commodities are a sea of green at the minute as well. So the oil price is up about almost 2%, so $81. I think what's also supporting oil as well is that Venezuela's largest oil mine has been essentially cut off, or oil refiner, I should say. And in other commodities, it's pretty much a sea of green. So lots of optimism on the back of those restrictions being announced this morning in China. It's just a matter of if momentum can continue, and I think that may indeed be the case until we get the next catalyst. Redmond.
I think we have covered everything. I think we have covered everything. I think we should stop here. And everyone has a very happy trading and successful trading this week.
Thank you for tuning in. See you next week. Bye-bye.
Bye. Don't forget to reach out to your GST or your RM if you've got any questions, feedback, or comments.
Bye-bye.